Federal income taxes can be a major obstacle on your way to financial independence. And that's why you should be focusing on minimizing your taxes if you want to achieve financial independence in lots of circumstances. Luckily for you, in this video, I'm going to give you all the tax strategies that you realistically need to know in order to minimize your federal income taxes and get yourself on the path to financial independence. The first thing that might be really helpful here is just briefly touching up on how federal income taxes work. Now, I'm not going to explain in detail like every single thing how it works. We're just kind of like recapping here. So basically, you have federal marginal tax brackets. Let me put that on the screen for you. And if you fall into those marginal tax brackets, that is a portion of your income is going to be taxed at that rate. So for example, if you look at a single person in the 22% tax bracket, their taxable income is going to be about anywhere from $40,000 to $85,000, within that range. And some of their income is going to be taxed at 22%, but not all of it. And that's why, even though you might be taxed some of your income at 22%, it's just going to be that next highest dollar. So you actually have to first work your way up the tax brackets. So the first, for example, if a single person, the first $9,875, that amount of income, taxable income I should say, is going to be taxed at 10%, and so on up the kind of ladder you have going on there. And I've actually done a complete video in the past explaining a lot more detail on how federal income tax brackets work. So if you need to learn that, make sure you look for that video on my channel. And now we know how these federal income taxes work, it's best to know how you're actually going to reduce them. And I have 5 really major concepts that we're going to be talking about in this video today in order to take these strategies and minimize your federal income taxes. And the first one that I have here for you is utilizing your employer retirement accounts. Okay, the second one is going to be adjustments to your income. The third one is going to be tax deductions. And fourth, we have tax credits. Those are a major player in your tax strategy. Lastly, at number 5, we have a bonus strategy for you. So make sure you stay to the end of the video if you want to find out what that bonus strategy is. In order to make this, actually pretty smooth and actually put real numbers onto it, I've actually created a little scenario for us here. And in this scenario, I'm going to be using about the median household income. Okay, so we're going to take a single person, working at a regular job, making, W-2 income, and they're going to be making the median household income. Okay, so the median household income in 2019, according to the U.S. Census Bureau, is $62,843. So that's, somewhere around there. Half of all people, or I should say half of all households make above that, half of all households make below that. So it's not completely unrealistic for, a single person, maybe someone who has graduated college, to be, earning that kind of income. And a big influence for this decision to use a single person in my scenario is actually this poll. You can see right here from YouTube. About 63% of respondents for subscribers of Uncapsulous said that they do file single. And so I think it is a lot more helpful to use this scenario with a single person. And now let's get down to it. Okay, the first one that we have is the employer retirement accounts. Okay, so this can be pretty much anything that's offered by an employer. Now, typically, if you're working in the private sector, it's going to be a 401k. But if you're working for the military, it's the thrift savings plan, or other federal government as well, the thrift savings plan. If you are working for maybe some state and local governments, it could be 457B, 403B. That doesn't really matter too much, but really they mostly have the same rules. So employer retirement accounts, I'm going to be using the example of a 401k. So in our example, the person that is making that median income, they can contribute the maximum amount to their 401k. And that's because 401ks, we're talking about traditional ones here where you can actually take a tax deduction. So the 401ks actually have no income limits. So it doesn't really matter how much you are making, you can contribute the maximum amount to your 401k. And that is a really great tax strategy. So in 2020 tax year, it was $19,500. And it's going to be the same for 2021. And so $19,500, that's basically the amount of income, if you contributed the maximum, that you would not have to pay federal income taxes on. And possibly that could apply to your state as well, but we're only talking about federal here. So the person that we have our little example of, the single person made $62,843. And then they contributed the maximum to their 401k, which was $19,500. This leaves us with a take-home pay of $43,343 because basically that $19,500 contribution is not going to be taxable. So that is number 1. You need to utilize your employer retirement account because it is a great opportunity for minimizing your federal income taxes. The next tax strategy that we have here for you is number 2, and that is utilizing adjustments to your income. So adjustments to your income can be found on the tax form Schedule 1, okay? And it's actually going to be part 2 of that tax form. And not everything on the Schedule 1 Part 2 is going to apply to you. So the most common ones that I like to kind of talk about on Schedule 1 are going to be the HSA, which is the health savings account, the IRA, which is referred to the traditional individual retirement account deduction, and the student loan interest deduction. Okay, so even though I'm saying they are deductions, they're technically adjustments to your income, and those are going to be regardless of what kind of deductions you take, which we're going to talk about later. But as far as adjustments to your income go, almost anybody, can have access to these three. If you have went to college and you have, qualified student loans and you're paying, student loan interest on those loans, then you might be able to qualify for the student loan interest deduction as long as your income doesn't go above the limits. Now, we're not talking in detail on everything and how these work, but for our example, the person making the median income, they do qualify for the student loan interest, adjustment to your income. They do also qualify for the individual retirement account adjustment to their income, how much they contribute to that, as well as it doesn't matter what your income is for an HSA, a health savings account. If you're eligible to have a health savings account, then you can take a deduction for your contribution, up to the limit. And so for the limit, for our example, for the HSA is $3,550. And so our person that is wanting to maximize, their tax efficiency, they are contributing that $3,550 as a single person. For the traditional IRA, they can contribute up to $6,000, per year. And so they are, maximizing that, and they're putting $6,000 in there as well. And then lastly, the student loan interest. Of course, it's going to depend on how much you actually pay in student loan interest, but the maximum that you can take as an adjustment is up to $2,500, as long as you meet the requirements. But for our example, we're going to assume about $1,500 of student loan interest paid in this tax year. And so what do we have all combined? So we're going to add up that $3,550 for the HSA, we're going to add the $6,000 from the IRA, and then we're going to add the $1,500 from the student loan interest. And what we get with all that is $11,050. Now that is going to adjust our person's income down, just as the 401k contributions did. So this amount of income is not going to be taxable. So before, we were down to a take-home pay of $43,343. Now we're going to adjust that down with $11,050. And I have it right here. This will make their adjusted gross income be $32,293. And generally speaking, if you do want to get a lower tax bill, then it's going to be beneficial for you to get your adjusted gross income down. Okay, first we had their gross income, which was their take-home pay in this case, after their 401k contributions. And then we took our adjustments using Schedule 1. And then after that, we have our adjusted gross income. In this case, with the single person making the median income and maximizing all these tax strategies so far, they have an adjusted gross income of only $32,293. But we're still not done here, because number 3 on this list, they are going to be utilizing tax deductions. So we haven't even gotten to actual tax deductions yet. When it comes to tax deductions, you have 2 options here. You can either take the standard deduction, which is going to be the same for everyone, or you can itemize your deductions, also known as itemizing your taxes. And luckily, for easy math sakes, most people are going to utilize that standard deduction, and there's a really good reason for it, because the standard deduction is actually pretty darn high. You would have to have a lot of itemized deductions in order to even get close to the current standard deduction. So in the 2020 tax year, that standard deduction was $12,400. Okay, so basically what that means is, for everyone, regardless of their adjustments to income, regardless of if they utilize employer retirement accounts or any retirement accounts, regardless of that, the first $12,400 in 2020's tax year, they're not going to pay income taxes on that. And there's a reason why I'm using 2020, by the way, for these taxes. It's just because it's already passed and we have all the tax forms and all the information that I can show you up on the screen. So it just makes it a little bit easier. But the same rules apply in 2021. The same rules are pretty much going to apply in 2022 and so on. So just keep that in mind as we're going through this. I'm just using 2020 because everything is already published. It's already out there, all the forms and everything. So for 2020, it was $12,400, that standard deduction. So that's going to be after our adjusted gross income. So we took the adjusted gross income that we had earlier, we're going to subtract the standard deduction, okay, and then after that we're going to have what's known as the taxable income, and that's the income we're going to plug into those tax brackets that we mentioned in the beginning. So I have the math right here. The AGI, the adjusted gross income, was $32,293. Then we're going to subtract that $12,400 for the standard deduction, and then we get a taxable income of only $19,893. And like I mentioned earlier, the reason why I am just sticking to the standard deduction is because 9 out of 10 people are going to benefit more from it, or they're actually going to utilize it. Now, it's about 9 out of 10, maybe not exactly 9 out of 10, but usually only people in the highest income brackets are going to actually be utilizing those itemized deductions. And in this case, we are using a median income, and for the most part, most people making around the median income are going to benefit more from the standard deduction. If you do want to learn a lot more about itemized deductions and the standard deduction. In the past, I have done a full video on that, so make sure you go check that out if you are interested on my channel. But now that we have our taxable income, it is only $19,893. We can go ahead and plug that into the federal income tax brackets and find what our taxes are going to be, like what's going to be based on our taxable income. And if I go ahead and put that chart back on the screen, the federal income tax brackets, you can see that $19,893 for the single person is going to put them into the 12% marginal tax bracket. And the way we're going to calculate that is the first $9,875 is going to be taxed at 10%. Okay, so that's going to be a tax bill of $987.50. Now, the next amount of income is going to be at $10,018, and that's going to be taxed at the 12%, okay? So that's going to be $1,202.16 of tax. So we got to add those two taxes together, and we'll get our total tax bill. That should be $2,189.66. Now, hopefully I did that correctly, mathematically wise, but if I didn't, it doesn't really matter because that is basically the concept of how those marginal tax brackets work. By the way, if you are liking this video so far, please make sure you like and give it a thumbs up. It really does help me out, and I really do appreciate that. Number 4 on minimizing your federal income taxes is to utilize the tax credits, okay? So there are so many tax credits, and it would take a long time to explain all of them. But here are some of the most known and most utilized tax credits. So the first one is the earned income tax credit, and that's mostly going to benefit, lower income workers, or families, especially families with children. The next one we have the child tax credit. So people with children, they get significant tax benefits. The next one we have is the other dependents credit, almost like the child tax credit, except for it is a lot less generous. It's for someone who has a dependent that is not a child, a qualifying child. Then we have education credits, which is like the American Opportunity Tax Credit, which is very generous for your first 4 years of college. We have the Lifetime Learning Credit, which is beyond the first 4 years of college. You can utilize as long as you have higher education expenses that are qualified. And then lastly, we have the Savers Credit, which is another very popular one, which is the one that I'm going to be using in this example. Okay, so the Savers Credit is basically a benefit for people who save for their retirement. Now, it's only going to mostly apply to people making the median income and lower, and it's going to be a little bit easier to apply if you are married, filing jointly. But even this single person right now fits into those brackets. It's going to work for them in this scenario. The way that this Savers Credit basically works is it's going to give you a percentage of how much contribution that you put into your retirement accounts based on your income. Now, for our example, we are only going to be able to qualify for 10% of our contribution up to $2,000. So for the single person, they only qualify for $2,000 worth of a contribution, and the amount of adjusted gross income that this particular example has, it's only going to allow them to get 10% of that $2,000 contribution. So in this case, the Savers Credit is only worth $200 for this hypothetical example. But for someone that might be making less than the median income, or someone that's making the median income but they're married filing jointly and they're contributing a lot to their retirement accounts, they might be able to qualify for a much larger Savers tax credit. But for our example, the Savers credit is going to take off $200. So originally we calculated that at $2,189.66. We're just going to subtract $200 off of that with the tax credit. So after the tax bill has been calculated, we can take the eligible tax credits and deduct that from that tax bill. So in this case, we end up with a $1,989.66 tax bill. Maybe that might sound like a lot, maybe that doesn't sound like anything to you, but if we go ahead and divide that into our original income, we take that bill of $1,989.66 and we divide that by our original income, which was $62,843, we get a effective tax rate of only 3.17%. So in this example, we have a single person making about $62,000, but they're only paying effectively about 3% of their income in federal income taxes, which, utilizing all these strategies, mostly saving for financial independence, saving for their retirement, basically utilizing some of these smart strategies in order to achieve financial independence, you can get your effective tax rate as a single person making that much income down to 3%. And of course, this can be applied, whether you're single, married, filing jointly, making the median income, making less than the median income, and pretty much up above the median income up until you hit some of those income limits where you might get phased out. Overall, I don't think that is too bad. But don't forget, we do have number 5 on here, the bonus step for optimizing your federal income taxes. And the bonus step, it kind of isn't just one single step. It's actually kind of an accumulation of many different steps. And that is that you should be tracking everything when it comes to your financial life. And, it can be a headache if you're trying to do this, utilizing, spreadsheets or going over your, credit card statements and all that kind of stuff, trying to track all this stuff on your own. It could be very complicated. Luckily, we don't have to do all that stuff manually. If you are tracking, that is one of the best things that you can do in order to set yourself up for minimizing your federal income taxes. That way you know how much your income was. That way you know how much you need to contribute, to your retirement accounts or to your HSA or whatever it may be in order to get down to the tax level, the tax bill that you want to be at. And so that's why I would recommend that you check out Personal Capital. Just go to oncashflow.com/resources, and it's going to be there on the page for you. You can just click through there and check out Personal Capital. It is a free online software that I use in order to track my net worth, in order to track my income, track my budget, and everything all in one place. You just link up your accounts. It is that easy. Now, they are an affiliate of mine, which means that just by clicking through that link, just by going to that webpage, oncashflow.com/resources, you are helping out the channel, and I really do appreciate that. Thank you so much for watching this video. I'm Zach from oncashflow.com, and I hope to see you next time. You pause it?
Oh, wait. No, I didn't.
Come on, producer.